Hello and welcome to another episode of Be the Bank. My name is Robert Haitha, your host, and this is the best place on the internet to learn about the secondary mortgage market. My apologies for this slow transition there. I'm a little rusty, got a lot on my mind. As you know, if you saw last episode, I'm now a father. In between our episode 36 and now episode 37, I had a child, and we didn't know if it was a boy or a girl until the delivery, and it was a boy. We have a son now. I'm so excited to share that with you and to be a dad now. It's crazy. But without further ado, I do want to jump into today's episode all about sustainability, which I think is so important. Now as a father, it's like a whole new thing to consider. Not that I haven't in the past, but passing along this planet to a future generation is just so much more real now. So let's jump right into today's episode number 37. And let me make sure I know how to do all of this stuff. All right, let's go. All right. Episode number 37, folks, we're going to start with free resources for note investors. Then we're going to talk overview of the industry. Then we're going to go over why this business is so awesome. You can run it from anywhere with a laptop and a phone. We're going to talk asset acquisition opportunities. Then we're going to go through a couple of case studies, some interesting ones this week. And then finally, I'll explain to you our giveaway, how you can get on a free consultation call with me to talk shop. And I can help you get into the note business or take your note business to the next level. All right, so before we jump into that though, we do want to say hello to our friends. We've got the birds. Just cleaned and refilled that feeder, but nobody seems to be a taker yet. We'll check in with them in a little while. I've also got this cool transition. And no takers over there either. So we'll keep an eye on both of those angles. We'll say hello to them again, the birds and the fish, and maybe catch a glimpse in not too long from now. All right, so let's get right into the show here with some updates, some industry overview news. And I do want to start just with a quick pitch. Let me know if you've already seen this too many times, but I do want to share our website, a resource for the industry, our mastermind group for savvy entrepreneurs, and consulting with me for your success. So our website is 100% free, and it unlocks how to invest in mortgage notes, our industry news aggregator, which my next slide, I'm going to show you how that has actually changed, and then our limited mortgage note inventory. So you can sign the non-disclosure agreement to get access to inventory mortgage notes for sale on our website. But if you join the Mortgage Note Mastermind group, you get complete access to our mortgage note inventory along with our aggregated trade desk, which includes so much more assets from across the industry from our members and from other brokers and market makers out there. So you can find a note that fits your portfolio. So much more available to you in the Mastermind group. And eventually the Mastermind membership, which you can find at FIXnotes.com/MNM, will be $990 per month. That's the future cost of this Mastermind group. But as an incentive to join today, to be an early adopter, within the first 100, we're approaching 100 members now. It's actually only $110 per month. And that price does increase by $10 for every 10 new members that join. So that's how we incentivize our early adopters and also align the value that this group achieves through the network effect. The more members that join, the more valuable the resources for everyone with the price. So as new members join, the price does increase. So be an early adopter today. I think there's only 4 seats left at $110 per month. And then of course, Mastermind consulting for my members is half price. So $180 per hour to be a consultant client with me and pick my brain on really anything regarding the mortgage note business, real estate, the internet, automations, marketing, or YouTube. Not that we have a huge following on YouTube, but we do try to be consistent. So that's important. All right, so let's jump right into it with the industry overview. This week, tomorrow actually, begins the Diversified Mortgage Expo. September 30th to October 1st. Now this was taking place in St. Petersburg, Florida, but they went all virtual because of the COVID numbers in Florida. A lot of participants were voicing their concern. I let you guys know 2 weeks ago that I thought it was a tentative kind of situation, and they did make the call. The organizers did decide to go all virtual. So you can join at diversifiedmortgageexpo.com using the promo code FIXnotes, and that will give you a discount. I think it's 10% off, not totally sure, but definitely go check it out and see if that would be a good fit for your continued education. Now, I have been a speaker in this event in the past. I'm not speaking this time around because we just had our little baby and I wasn't planning on making it to Florida. I'd love to do it now that it's virtual, but I think they've already organized the schedule at this point. All right, so final piece of the industry overview here, the website refresh. So I made time somehow in this last week to also update the FIXnotes website. So here's the new face of FIXnotes, and I'll just pull myself off of here. This is take control of your financial future today, the industry's best resource. So if you go check out FIXnotes.com, you'll see some changes. And you will see if you do, well, this is kind of a tricky situation here. There's, for whatever reason, when you update a website, the cache, which is if you have already visited the site, your web browser loads up a cache of images and different templating items of the site. And if this looks nothing like this when you go to FIXnotes.com because you visited before and your cache is loaded, you may have to clear your cache, which is super easy to do in Google Chrome or Safari. Just go to Preferences and Browsing History and clear your cache. And then it will look like this if it doesn't already. If you're a new visitor, you shouldn't have that problem at all. But some changes here. The main one is this Learn Notes section where we house the industry news aggregator is actually being converted into a blog. I'm very excited to start using the FIXnotes website as a more active, and the industry news aggregator, of course, was this. We were actively putting new articles out every single day that we could. More often than not, it was once a week we'd aggregate new articles. But now we're going to be more curated with the blog to post features, to post case studies, and to consolidate the industry news with my own narrative on top of it. So the blog is under fixnotes.com/news at the moment, and it's not populated yet. There's one case study on there, but I'm going to work on that very soon to give you so much more content on this industry. So let's jump back into it with the business here, the mortgage note investment options. So as you know, there's many ways to invest in mortgage notes, from passive to active, and our focus is on the active side. We go all the way to buying and working out non-performing loans, because that's what I believe is the most important factor to understand when you get into this business. Because whether you're investing in a fund or buying reperforming loans, everything is based on this piece. Buying and resolving non-performing loans. That's what the fund managers are doing if you're investing in a fund. And that's what a reperforming loan was at one point. It was non-performing, and then an investor made it performing again. So even if you don't intend to do this side of the business and you intend on being a more passive investor, it's still super important to understand. And that's what we focus on our show. We go all the way to the active end of the spectrum. So a couple more points here before we jump into our due diligence waterfall, and that's the market pricing for September. No changes at the moment, so I just want to skim through this pretty quickly. Senior liens are priced between 7.5% to 12.5% when they're reperforming, and that's based on yield. So every single year you get between 7.5% and 12.5% of your money back. That's your return on investment on an annual basis when the loan is actually cash flowing. Junior liens have stronger yields. You typically are incentivized when you buy riskier quote unquote assets, but you know that I like juniors better, and you can mitigate all of that risk and still achieve the higher returns when buying juniors. And then on the non-performing side, pricing is valued as a percentage of fair market value and unpaid principal balance. So when it's reperforming, we know that there's cash flow coming in, so we can price based on a current income every single month, that mortgage payment. But when it's non-performing, we price based on a discount to fair market value between around 8.5% to 80+% of the fair market value, with a cap on the unpaid principal balance, of course, because you're not going to pay more than the debt that's owed. And then on junior liens, you do price based on the unpaid principal balance from around 5.25%, and maybe it's a little bit north of that these days, up to 75%. And I've seen a handful of deals higher than 75% of the unpaid principal balance. So all of this pricing, though, is based on your waterfall evaluation. So if you are doing this non-performing waterfall evaluation, you can define where the pricing is actually going to be determined based on the characteristics of that specific loan. So if you start at the top, I'm backwards now. Start at the top over here with secured and unsecured. That's the first, we did this in the beginning of the year. We started going through every single point along this waterfall, and this was episode number 29. We talked about secured versus unsecured, some false positives, some false negatives, how to actually do the research, and you can go back to episode 29 to get a much better understanding of secured versus unsecured. Then in episode 30, we talked about junior versus senior liens and why I prefer, I'm calling myself smart money, but why I prefer juniors, why a lot of investors do prefer second liens, especially when you have lower dollar amounts to deploy. Now, first liens, you can deploy much larger, tens of millions of dollars into buying first liens. Junior liens are a smaller market, and typically the investors have maybe 10 to 20 million max, and that's a huge trade in juniors, whereas most junior lien deals are around $1 million. But junior liens have many advantages, and we talked about that in episode 30. Then in episode 31, we talked about collateral valuation methods, and we explained how you can go from these free resources all the way up to the paid resources to get more accuracy, but finding a sweet spot right in the middle with recently sold comps, doing a manual review of the recent MLS activity in that market using Zillow typically. So that was episode 31. And then episode 32, we talked about bankruptcy, the difference between chapter 7s and chapter 13s, reorganization versus liquidations of debt. And you can go back to episode 32 to learn more about that. We talked very tactically how to actually do the research using the voluntary petition and the Schedule D, especially for secured claims. And then in episode 33, we talked about occupancy triangulation. So important when buying notes to determine whether or not the borrower actually lives in the property. So we talked about some ways to do that and some results and how to interpret those results. Episode 34, we talked about title reports. Now we're just going down the list of that due diligence waterfall. Using ownership and encumbrance reports from Pro-Title is what we actually went through step by step to understand that report. Then we talked senior lien status in episode 35. When you're buying junior liens, senior lien status is just so important. In our episode 36, which was last episode, we talked about equity analysis. And I showed you some really cool Excel formulas that you can use to determine into these stratifications, underwater, no equity, partial equity, or full equity, so that you can compress a data tape of up to thousands or 10,000s of assets. If you have these right numbers, the fair market value, the senior balance, and the junior balance, you can calculate these stratifications for pivot tables and reporting in a very quick and easy way using formulas. Super cool. All right, so let's zoom back out to the non-performing waterfall evaluation. We've covered everything on this list all the way down to taxes. We haven't talked about taxes yet, but before we get into that, let's see if there's any friends out there. I don't see any birds, so let's check the fish first. Oh, there's some koi and a goldfish there. And they're just hanging out, waiting for food, but they're gonna have to hang on for another 45 minutes or so, and then we'll go out and we'll feed the fish. No birds though, no birds. So let's zoom in on taxes and talk about why property taxes are so important to research when you're buying first position liens. So first liens, when you're looking at a tax balance, it's much more important because generally second lien holders take something for granted. That is, the first lien, if it's current, is also escrowing property taxes. To protect their lien position, a first position mortgage in front of a potential junior lien investment is making sure the property taxes are paid. Because if they're not paid, they could potentially be lost to foreclosure. Just like a junior lien looks at the senior lien status to make sure they couldn't be wiped and become unsecured from a senior lien foreclosure, the senior lien holder looks to the taxes to make sure they're paid so that they don't get wiped and go to unsecured status. So, especially when researching seniors, property taxes are an important consideration for equity and the future liability of the asset's secured status. Now, best case scenario when you're doing your due diligence is there's complete records available on the county tax bill website. Less ideal is that there's limited records online and you'll have to actually call in the tax assessor or the tax collector. And then worst case is that you check the sheriff sale details and the taxes have already been sold or they're on the way to being sold through the property deed or the property tax certificate process, which we'll talk about in a minute. So a couple of vendors that you can use to research in bulk or individually are Pro-Title USA, which on the O&E report that we discussed in, what was that, like episode 32, I believe. Maybe it was before that. I just said it, so just rewind. We talked about the tax status on the O&E report. Now, some counties do require certifications, and that just means that there's going to be a more manual process required in order to get an accurate tax balance. But in most cases, the O&E report will have a tax balance and the delinquent or current status of that tax balance on the actual O&E. So it's kind of a one-stop shop. If you're pulling title for first lien research anyway, you've got the tax data there. Now, another potential vendor more for bulk, larger volume due diligence is CoreLogic. Residential Tax Solutions will give you this data as well. CoreLogic is especially useful because they will actually help you with the escrow and payment of the taxes as well. If you sign on a contract with them, if you're a much larger investor, you can actually have CoreLogic handle the property taxes and keep them current for you. First American has another product called TaxSource, and First American owns DataTree. We love DataTree for one-off due diligence research. We talk about DataTree pretty often. Every time we talk about the tech of this business, we give them a shout out because it's an excellent resource for one-off due diligence. And TaxSource is just kind of like a different item in the First American suite on DataTree's portal. So you can also use their API, which if you create a very automated system, now I haven't plugged into this API myself with our platform, but we do use automation whenever possible. So this is definitely a future thing to tap into. APIs are so cool because they create automation between different resources and vendors out there. Make your process tight, efficient, and very quick. All right, so let's get into it a little bit more about tax research. So I'm gonna zoom in like this. And now you can see Charleston County, South Carolina. So this was a little bit of research I was doing yesterday on a specific property tax situation, and I'll pull myself off for a minute. And I apologize, the little puppy's barking back there. Little David Rose now has a brother, which is crazy. He's been acting a little weird now that I have a son, which is still so weird to say. Okay, let's get back into this. So this specific property, we researched using the Real Property Record Search, right? If you can see my mouse, right up here, Real Property Bill Search, and then clicking on Tax Info. And that's what's really great about Charleston County. I wanted to use it as an example because this is a best case example where we've got a tax info selection that we can make. And if we click that, we get this page with the tax bills all the way back to 2017. And I believe there was even a more years under here that's been cut off. So you could rewind back to 10 years ago and see if this borrower has been keeping current on the property taxes. Great news on this count. Paid. The last 4 years, paid. All these taxes, you know, they did pay a couple fees. 2 years they were delinquent a little bit, but they've been making, the penalty there, but they've been making their payments every single year. So that's great news for a first position note investor who's buying this lien to research and find that the borrower is paying their property taxes. Now, it's so important because just like when you're reviewing a second lien and you look to the senior lien status for the borrower's intentions, the borrower is paying the property taxes. They have this vested interest. Obviously, they always have a vested interest if they own the property, but some borrowers end up in like a strategic default type of situation where they owe so much on their taxes and their mortgages that it isn't really worth it anymore and they kind of check out. But in this case, the borrower has absolutely not. They're paying their property taxes, so it's just a matter of time before we work out a deal on their mortgage as well. So very important to understand in this best case scenario, all that detail on the property taxes. So let's talk a little bit more about property tax research and some pricing considerations. So when a property tax is delinquent, you really need to know how to protect your secured interest, or at the least, before you buy the loan, how to price that asset if you haven't purchased it yet. So a couple of pricing considerations in your due diligence. Let's start with number one. If the seller represented the taxes as current, then you need to apply a pricing fade for that delinquent status. So that's a really important thing to understand. If the seller of a loan lets you know that the taxes are current, well, then that's been represented properly. But if they say, hey, these taxes are paid, the borrower, you're assuming this, the borrower wants to stay in the home, continue to pay the taxes and eventually pay a non-performing mortgage that you're potentially buying, then that would be a good thing. But if it's actually delinquent, that would be a very bad thing. That borrower may not want to pay the taxes, may be checked out, like I said, in a strategic default type of situation. So you do have to apply a pricing fade. And that essentially means that your indicative offer needs to be reduced in light of the research that you've uncovered in your due diligence. Next point here, you need to net out the delinquent taxes from the fair market value to recalculate your offer. So it's one thing if the taxes were represented as current and they're actually delinquent, that pricing fade is a lot more significant. But if the pricing was already calculated from the start as delinquent taxes, but they were just a little bit more delinquent than expected, then you need to net out those additional delinquent taxes from the fair market value, because essentially that's an adjusted equity number offering less money to you as a note investor to secure your lien. There's less available property balance after those taxes have been paid. So that's a way to recalculate your offer. If the taxes were expected to be delinquent, they were just a little bit more delinquent than expected. Now, finally, negotiate for your seller to bring the taxes current prior to the sale of the lien, if possible. If you're buying a loan, especially a first position asset that's pretty high value, you can actually work with the seller to get those taxes paid off so that when you buy it, it's actually been brought current already. Now, this is probably unlikely in most cases, but definitely possible. More likely when you're buying a reperforming loan with delinquent taxes, the seller might get those paid off for you. And those, as we'll see very shortly, are recoverable advances. If you're paying the property taxes on behalf of a borrower, the borrower owes you for that, and it's going to be added to the loan balance at some point. So let's talk about if you own the loan already and you do this property tax research. First of all, you need to understand the county process. There's tax certificate areas and there's tax deed areas. These are different counties, different townships that treat their delinquent taxes in different ways. Now, actually, in our case studies today, we're talking about, I think both case studies have tax information, delinquent tax situations to talk about. So we'll get into it a little bit more there, but essentially, this is the process by which a deed to a property is lost, liens become unsecured, the borrower no longer owns the home because they didn't pay their taxes. Normally, they give you a good amount of time, and there's always a redemption period. So you really need to understand when a redemption period expires so you know your deadline as an investor to protect your interest, to protect your lien. Now, there's also a per diem rate. It just means per day, and that means that there's an additional accrued interest that's being added on to that amount that's owed. And if you understand the per diem rate and if it's higher than you'd like to see as an ongoing expense on the loan, you could pay off the taxes earlier. You'd be doing the borrower a really big favor there by paying them off sooner. But if it's a very nominal amount, sometimes you can wait to pay off the taxes until you come to some resolution event. And that's can be part of your resolution, whether it's to help the borrower with a quitclaim deed or to help them short sale the property or to get a modification agreement in place. Settling up the taxes can be part of that agreement process once you're working with the borrower directly. So if a payment is necessary, you do need to make sure your servicer understands that that's a recoverable advance. Your loan servicer can add that balance that you're paying towards the taxes to the accounting on the loan. So that eventually, if you were filing for foreclosure, for example, that it would be itemized as a recoverable advance for property taxes that were paid on behalf of the borrower by the lender, by you as an investor. All right, so that's property tax research, a whole bunch there, and I'd be happy to answer any questions at all if you'd like to give me a comment below, and I'd be happy to get into some more detail if you have any questions about it. But that gets us all the way through the due diligence waterfall, every single bubble along the way, starting in episode 29, all the way up to episode 37 over the course of 2021. So if you have any questions at all, we'll definitely recap these in future episodes, but it'd be nice to know from you what was still maybe needs some more clarification. So let's hop over to our next slide, which is tech tips. And then we'll get to our feature for today on sustainability. But before we hop into that, let's just see the fish. Yeah, there's some goldfish. There's a nice white koi up there in the upper left. Oh, and there's a speedy little gold guy. Hopefully going to get an underwater camera to give you guys a better view in a future episode. And any birds? It looks like it's swaying like there was a bird that we just missed, but it happens. Okay, so tech tips. This is a quick overview for you. If you have got the necessary hardware, a capable PC or a Mac, and you've got a decent phone and fast Wi-Fi or cellular connection, you can connect all of these software and web services together to create this amazing automated business. Now, it's not entirely automated. There's still a lot of things that you need to do as an investor, an active entrepreneur in this space, but these tools make it so much easier. We use Podio as our CRM platform. Podio is very, very cool because it provides much of the power that a system like Salesforce would provide, but it does it in a way that I feel is much more user-friendly, much more intuitive, and you can definitely customize it a lot yourself. And we actually host our Mastermind membership group on Podio, which is free to join for up to, I think, 3 users. So when you join the Mastermind group, you get a free Podio account with it, and then you can use that Podio account to experiment and get your CRM type of activities together. And using Podio plus Citrix Podio workflow automation, we connect it to all these other web services, create some really cool flows and automations. Now, just to highlight the other things here, we've got Pacer, public access to court electronic records. That's where we review bankruptcy information. We use Right Signature to get our sales contracts approved and executed digitally. Use Gmail a whole heck of a lot, maybe more than I should. I should be automating more of my Gmail activity in Podio, but it is what it is. Zapier is a way to connect Podio with other web services without knowing any coding, which I like to use for my minimum viable product. Now I say product, but more like my minimum viable automation flows. And then I work with a developer to really program that into Citrix Podio workflow automation. CoreLogic, we've talked about already in this call about taxes, but CoreLogic provides so much more than that as far as data is concerned. And you can use CoreLogic in bulk research very effectively. Now, DataTree is much better for one-off from First American. These two used to be the same company, First American and CoreLogic, but they split, I think about 10 years ago or so. And I think that is for a good thing because DataTree is a much more approachable solution for one-off note investors. And I think that's really important in this business. That's why I do this show, is to get new investors into this space to be more sophisticated with their real estate investments when it's really a bigger type of firm game. And you want to make sure that you can level the playing field as an investor by using tools like DataTree. Now, Zillow is just an excellent resource to review MLS listing information, and we use it all the time. Google Sheets and Excel, crucial, imperative. Even with Podio, I still need to use Excel all the time. ProTitle USA for our O&E reports, ownership and encumbrance reports, and then TransUnion for credit, TLO for skip tracing. There's many other resources for credit. There's a couple of different bureaus, Experian, Equifax, and TransUnion being the big three. And then TLO is just one of the possible skip trace vendors. These two companies combined it. So you can actually sort of get both of this data from the same source at this point. All right, so let's get into the feature for today, and that is sustainability. And sustainability is just so important in today's world that we live in. There's 7 billion plus people on this planet, and our planet is a limited resource. So we need to think in terms of sustainability in all we do. And because this show is about note investing, let's talk about sustainability with regards to note investing. We'll start with a quote from Mark Twain. Plan for the future because that's where you're going to spend the rest of your life. I mean, it's so simple, but so true. We're all going to spend the future on this planet, so we need to think in terms of stewarding this planet in a way that's sustainable for the future generations. Now, it's tough these days because a lot of the people who make the big decisions have a lot less life ahead of them than, for example, my newborn son. So they don't really consider this in the way that the younger folk like Greta Thunberg does. But it's still important for all of us to consider because economically, as well as socially and ecologically, it makes sense. So let's talk about the sustainability spectrum here. So the spectrum as I see it, is from an individual all the way up to societal. And on the individual level, to talk about the ecological impacts is kind of nominal. And that's something that I think is a sort of frustrating in today's world, where big corporations are trying to guilt consumers into being, and of course this is important, to be more sustainable with packaging and to recycle or do composting if you can. But the real big changes are way on the corporate side of things. So today's call, we're going to talk about the individual sustainability of your personal lifestyle, your structuring of your business, and making sure you limit burnout so that you can be effective and add value and create more community around you, as well as wealth. So that's the individual side that we're going to be talking about. Then we get up to the enterprise level, which, like I said, corporate level definitely has some ecological ramifications, but we're going to talk about how we can invest in ourselves to be more positive for humanity in general. Now, the enterprise level of sustainability, we're going to talk about sustainable cash flows, sustainable operations, creating a system that makes sense for the long term. And then for humanity, all the way on the societal side of the spectrum here, is creating a positive generational impact. So I actually had a couple things I wanted to talk about on this slide. So note investing is especially interesting as a microcosm of sustainability because it's inherently unsustainable. It's really interesting that note investing is transactionally oriented by nature. Loans may have a 30-year term. 30 years is a long time, but that cash flow does not persist indefinitely like you'd expect from a rental property. So unlike those rental properties that can be bought and sold or bought and held forever, notes are paid off and the borrowers move on. More often, they do move on through a refinance prior to maturity. So 30 years is a really long horizon for most loans. Most loans are paid off a lot sooner. But the fact that note investing This fact of note investing, that it is so transactional, is one of the reasons why I believe the resolution of non-performing loans is a more ethical, pragmatic business than many other endeavors out there. So note investors, our goal is to help borrowers pay off their loans, eliminate debt, and help secure their futures, these borrowers' financial futures. So this non-performing note business, it was created through unsustainable lending practices at these highest levels of finance, but then we're entrepreneurs. We can be the solution to these bad debts from the bottom up with these entrepreneurial efforts to set things straight. So I think note investing is so important as this niche in real estate because it's kind of cleaning up all of the unsustainable stuff that happened in the past, not generations, but in the past decade or two. So it's not sustainable as a business because we're actually cleaning up a mess that's been created that hopefully will not be perpetually in existence. So right now, the note industry exists. There's a lot of opportunity in it. There'll be much more opportunity in it next year when the CECL accounting reliefs expire and banks need to start selling the distressed debt that they've been kind of they've kind of hoarded this distressed debt because they didn't have to report their charge-off loans. So there's going to be so much more debt to clean up as these forbearance agreements expire and all of the fallout from the pandemic takes place. But hopefully this business won't exist forever. And that's an interesting thing about it. And I think that's why it's so important to be a voice in this industry, to speak towards creating sustainable businesses in an unsustainable marketplace and understanding that it is unsustainable and we are trying to resolve these debts, not perpetuate them forever. All right, so let's jump into the individual level. This is the first level of that sustainability spectrum. And I think the number one thing is just to make time for what's important. It's pretty simple. And I think that it's oversimplified in a way, but if you don't make time for what's important, the burnout is very, very, very quickly approaching. And that's what I think lifestyle businesses are such a more fruitful and just better endeavor than scaling up and trying to be a startup that gets bought out for hundreds of millions of dollars. Creating a lifestyle business creates an organization for yourself that fits what you are actually want to be doing and not in this grind forever. And that's where automation comes in. Leveraging automation is so valuable to note investors in lifestyle businesses because you do get to apply leverage to your efforts to create much more of an impact than you would as an individual. So I do believe that you should focus on focus on automation before delegation. Otherwise, you're just as bad as the big corporations that lay off to outsource to a less expensive place in the world for labor. So if you start with automation, then the hiring that you do it sticks. It's sustainable. You're working with employees for a long time. Now, I'm absolutely of the mind that you should give opportunities to people in developing countries that have a much lower cost of living. My employees are in the Philippines. And I think that because I never started with domestic employees and then fire them to hire people who are cheaper and better, honestly, than at least what I've found out there, that didn't create that dynamic from the beginning. I started with automation and then I started finding labor with great people overseas who can afford much lower cost of living. So it's cheaper for me to hire them and I pay them a much better wage than they'd get if they're working domestically as well in their own countries. So, and that's something we talk about in previous episodes about virtual assistants. There's some more details on that in the Mastermind group. If you have any questions, let me know. Now, avoiding investor capital is kind of my vision of freedom. I don't want to be beholden to my investors in a way that creates more stress, more pressure, more of a dynamic of being, working for someone. I want to work for myself. So I avoid investor capital. Now, not everyone has that opinion. And we had a really great conversation in a previous Mastermind members only call, which you can access the recording of as a member, where we talked about those different sides of the coin, whether raising investor capital to scale up and be a larger buyer is better or more effective in this business than using your own capital, even at a very small dollar amount. And that's something that I think everyone needs to make the decision for themselves. But personally, I believe that you have more freedom if you don't accept investors. So the individual level, that first point, making time for what's important and really structuring your lifestyle business is really easy to determine. Maybe not easy, but easier to determine when you look at this Ikigai finding your reason for being using this chart. Now, this was in episode 21. We talked about finding your reason for being and how the nexus point of what you're good at, what you love, what the world needs, and what you can be paid for is this passion where you can do, well, it's four things. It's your passion, your mission, your profession, and your vocation all in one. Ikigai. It's really, really a cool concept from Japan that I think we can all benefit from considering as we determine how we want our lifestyle to be structured. So definitely think about this in terms of what you want to do with your life. Now, this YouTube channel, I get a whole bunch of energy presenting on it. I get very excited when I get off the call. I've got energy for the rest of the day, something that I love to do. It's profitable because it generates new members for the mastermind group. And I believe, like I said in this whole section, it is what the world needs. And maybe I'm not the best at it, but I try to get better every single day. So I believe that presenting the show is my Ikigai. Developing the FIXnotes content to help other investors ethically be note investors, I think is my reason for being. So let me know what your reason for being is in the comments below. So the enterprise level, let's take it up to the next step, right in the middle, before we get to societal level. And the enterprise level, first thing is to don't lose sight of your acquisition efforts. As a note investor, you can get complacent with the portfolio that you have. With one of my clients, we were really excited on our morning call this morning because we just hit $20,000 a month in reperforming loan revenue, which is awesome. And it's a little less than it should be only because we did have to sell some reperforming loans in the last quarter or so. Actually, not the last quarter, it was earlier this year. But getting to that 20K per month level in reperforming loans is awesome. But if we rest on our laurels there, eventually those loans are going to get paid off either through refinances or when they reach maturity, and then that cash flow evaporates. So as a sustainable enterprise in this business, you do need to focus on your acquisition efforts. And that helps borrowers if you are an effective resolution specialist in this business because you're buying more loans that can be resolved. Talked to a borrower just the other day who was trying to resolve their $7,000 balance loan with a bank and just got the runaround. They would never accept this $4,500, so they were offering not a great payoff, but it was actually an unsecured loan anyway, which we'll do in a future case study. Actually, I think today's case study is very similar to this situation. But in any case, because this loan was sold to my client, who is an investor who sees this opportunity and wants to help the borrower settle the debt, we were able to buy a loan, settle it, make money on it, help the borrower save a bunch of money, and pursue future opportunities from that success. So it's very important to focus on your acquisition efforts so you have this constant flow of new borrowers to help, new assets to monetize, and to get back on the right track. Now, another thing which we've talked again and again about is optimizing your systems, processes, and procedures. And that's at the enterprise level because when you create a lifestyle business, you want to develop the business. There's a great book called Built to Sell, where not that you want to sell your business, maybe you do, but the point is that it's kind of a self-sufficient system. You've got a business that can run itself through the relationships that you've developed, the employees and the delegation that are in place, and the systems, processes, and procedures. So continue to refine those systems. And then keep an eye on your cash flow. This kind of fits with that first point of don't lose sight of acquisition efforts. If you keep an eye on your cash flow, you know when some loans are start to pay off and you need to start to acquire more assets to keep that number at the if you're an individual, at the number where you feel is your freedom level, where you have enough income coming in to pay your expenses. So keep an eye on that for sure. And then avoid investor capital. Already mentioned this, that equals freedom for sure. All right, so let's talk about the societal level. So the first thing is environmental, social, and corporate governance. This is called ESG. And ESG investing looks into firms' collective consciousness for societal and environmental factors. The overall positive impact is assessed with consideration for intangible assets other than profit. So in college, my university discussed this as the triple bottom line: people, planet, and profit. Those were the three bottom lines that you can focus on as an ethical organization. So there is a thing that sort of encapsulates this. It's called the B Corp. bcorporation.uk is firms that meet a higher standard of verifiably social and environmental performance, public transparency, and legal accountability. So that's one way that I think people are taking, voting with their dollars to have specific organizations that are qualified as ESG, organizations. There's a bunch of other metrics. Actually, if you go to Google and you just check a firm's stock price, there's a number on it. And I just did it the other day. I don't have this up, but let's see. If you look at their, you type in company name and stock, you'll see a CDP score, a measure of the actions a company takes to address climate change, CDP. So I just looked at Procter & Gamble, they're a B. So it's interesting, but I think that's sort of somewhat of a difficult number to look at, because when the largest corporations in the world are claiming higher numbers, there's some gaming to that system. And I think that it's interesting when you're an investor, well, we're talking about stocks here, to consider what your dollars are going towards when you invest in a public company. Now, in the past decade or longer than that, if you look at the growth of wages of executives versus employees, the numbers are staggering. The amount of income consolidation that's occurred in the last decade because of these increases in raises and stock bonuses for the higher management, the CEOs versus the employees, it's crazy. And that is not sustainable by any means. So in a big way, I think that investing in yourself and investing in a note business that you're creating to help borrowers is actually a much more ethical way to go into business than to invest in a stock that maybe is a hot stock for whatever reason, but doesn't practice these ethical and more sustainable business practices. Now, there's certainly public companies that do meet those standards, but I think that you can much better chance of success when you count on yourself. And especially in this note business where we're resolving bad debt, helping borrowers, versus kind of buying into this system of inequality that exists out there. So one more thing here, researching science of climate change and inequality. It's just so important to at least understand what's going on, because it's going to continue to go this direction as long as people are complacent. And I think I have a really great quote on complacency coming up, but we'll see. So here's that graphic on People, Planet, Profit. It's kind of like the Ikigai. It's funny, we've got two separate Venn diagrams here of multiple bubbles. But yeah, when you invest in yourself and your note business, you're working towards a better future than investing in companies that continue to exploit workers and the environment for shareholder profits. It's just, I mean, at this point, it's kind of a fact with most companies that they are extracting wealth to maximize value for their shareholders with little regard for some of the more important sustainability factors that exist out there. So you got to take matters into your own hands and invest in yourself. So I guess I don't have my second quote. I had a really great quote. Who was it from? Maybe I skipped over it. Let's go back a couple slides. No, I just have that one. All right, well, I'll have to throw that into another episode. It was a quote about, it was actually from JFK about complacency and how there's more, and you'll have to Google this quote for yourself because I'm going to butcher it here, but there's more risk for being complacent, being comfortably complacent than there is from taking action. And even if there are risks from taking action, those risks are going to be much less than if you just let things play out in a way that maybe becomes out of your control. So that's what I have to say on that subject. All right, let's jump over to those koi cams for a minute and see if we've got any fish. Yeah, there's a couple of fish hanging out, some goldfish. And I'm just advancing the slides here. So we can hop into case studies, I believe, before long here. Let's check out those birds. Nothing. No birds today. Isn't that a shame? All right, we are going to talk about assets for sale before we jump into the case studies. And the case studies this week I think are pretty good, so definitely stay tuned for that. All right, so our next offering date is Q4 of 2021. Expected to have some non-performing loans, some second position loans available for sale, but it's a bit tentative at this point, and those assets will go to the Mastermind members first. So I would highly recommend you at least check out the Mastermind membership. It is a 100% money-back guarantee to join. If you're not satisfied within the first 30 days, request a refund. We'll give you all your money back, no hard feelings. So definitely check that out. So you can get total access to all of our loans for sale. We've aggregated over $17 million of unpaid, $17 billion of principal balance in 2021 through the aggregated trade desk for Mastermind members, which is huge. These are assets from all over the marketplace. So you can look at first liens, second liens, reperforming loans, non-performing loans. They're all secured by residential property. For the most part, there's commercial deals that slip in from time to time, but mostly residential. $17 billion of principal balance that you can review. It's not all available now because a lot of it has been sold, but definitely a huge perk of joining the Mastermind membership group. All right, case studies. Here we go. So first case study today is non-performing first lien secured by vacant land. And this one resolved through a discounted payoff of $20,430. And this specific loan, fair market value is $32,000. So a pretty valuable piece of land, all things considered. Taxes were $10,500. There's about $21,500 of equity there, securing our unpaid principal balance of $45,000. So although 32 is a good number for land lots, 32,000, I've seen land lots worth less than $5,000, so this isn't bad. It was worth a lot more at one point because this loan was originated for $45,000 or more than $45,000. The balance now is $45,000. So this borrower is underwater, but the note investor has some equity. So this payoff of $20,430 was achieved after buying the loan for only $7,200. So we bought it for 33% of the equity. Remember when we talk about first liens, we're pricing based on the fair market value net of the taxes. So we're not pricing this on unpaid principal, we're pricing it on equity. Now let's talk about what happened, where are you now, and what do you want to do? These questions are so important because they frame your conversation with the borrower in a way that's effective to helping them with their situation. If you try to jam in your own workout in a way that doesn't fit with the borrower's situation, you're going to be an uphill battle. You're going to be fighting a battle that really doesn't have a clear success. When we work towards win-win resolutions, we do it in terms of what the borrower wants to do, what they can do. But in this case, it's interesting because the borrower is kind of out of the picture. The tax certificate was sold on this loan. The borrower did not pay their property taxes for good reason. This is exactly what we were talking about on our due diligence in this episode on tax research. When the borrower is in a position where it's just too much, they've got taxes, a mortgage, they owe like over $50,000 and the property's only worth 32, they sort of check out. It's a strategic default. They don't want anything to do with it. So their tax certificate was sold. Now in this specific county, Bay County, Florida, a tax deed goes to auction within 7 years of a tax certificate sale. So the certificate is sold when the taxes are unpaid for a year, and then the certificate holder applies for a tax deed sale. So we received, as the note investor, a notice of surplus funds. It's a form to complete so that we could request those surplus funds because they owe us $45,000 from this deal. And in order to complete that claim, we submitted that to the tax collector and then had to wait to see how much money we would get out of this property sale. So because we know that there's about $21,000 of equity, we're hoping that there's about $20,000 of payoff. And as you know, the spoiler, $20,430 was the payoff on this from the tax collector. So they sold the vacant land at a sheriff sale, just like you do when you go to foreclosure as a note holder. And then the mortgage, the first lien here, was paid off in the surplus that was available after the taxes were paid. So this one took 12 months, $560 of expenses to go from due diligence through the onboarding to the collection process, which was kind of nominal because there wasn't really much to collect on this deal. It was already delinquent taxes. We didn't feel like it would really make sense to pay $10,000 in taxes for a property that's worth $30,000. So we waited and eventually got a pretty lucky payoff here because that tax certificate did sell at the deed sale for more than the balance of our loan and the taxes. Or not more than the balance of our loan, more than the taxes, which allowed some balance of our loan to be paid off. Not all of it, but a good chunk of it. So a couple takeaways here. Review the property tax situation before acquisition. Well, you watch this episode, you know how to do it. Property taxes are super important. Now, by the way, if you're watching this case study individually as a timestamped link, in the bottom of this video, there's the scrubber bar of, the timeline of this episode. If you click the beginning of the episode, I guess it would be over here, you can actually see the chapter markers. So you can go back to the due diligence segment of this episode and learn a lot more about tax balances. So definitely do that if you are jumping into the case study and want to know more about researching property taxes. So you got to understand the property tax situation to understand the specific county's process so you know if there's previous years of tax certificates unpaid that need to be brought current, so you can understand what your timeline is, your per diem rates, your redemption periods. Now, to maximize the surplus funds, we didn't do this because it does risk you acquiring the property. You might not want to own a property in Bay County, Florida, if you live in Philadelphia, for example, but you could send a representative to bid on the sale. Now, as a note investor, you could protect your interest by having this third party or going there yourself and potentially bidding past the balance that this sold for. So it sold for around $32,000, and we were, awarded our $20,000 of surplus. But you could have bid this property up to $40,000 and got an extra $8,000, or you might have ended up winning the bid and then you take back the property. So it's a risk, but it is a possibility here to be more proactive on an investment like this. Then finally, record your assignment of mortgage so you can receive these notices. We received a notice of application for the tax deed as a public document, so then we knew that this was coming and we knew that we needed to file that notice of surplus funds form. So record your assignment of mortgage, so important. That's a takeaway on a lot of these case studies, so definitely don't forget that. All right, let's jump over to another one after, 170% internal rate of return. Great return over the course of a year. From a $7,200 purchase. This next one, though, isn't quite as strong. Our payoff was only $3,746. This one's a non-performing second lien secured by a single-family residential property. And, well, you'll see, actually, there's a wrinkle there. And it was also a discounted payoff, but not quite as effective as that first one. So the fair market value on this one was $46,381. The senior lien was $76,500. So we're way underwater right off the bat by negative $30,000, protecting, which it's not protecting anything anymore because it's negative, but our balance was $24,636. And the three questions here: what happened, where are you now, and what do you want to do? Also kind of out of the borrower's hands in this case as well. This property was lost to tax sale. So unlike the last one, which hadn't been lost yet, and we actually were paid in the surplus, this one was no longer secured right from the get-go. There was no excess proceeds, and it's now unsecured. It's not secured by single-family residential property. There's no fair market value. There's no need to even consider the senior lien balance because it's no longer secured at all. But we got really lucky because this borrower called in and they're like, we want to settle the outstanding loan to avoid the deficiency judgment. So they actually offered around $3,500 if we were able to release the remaining balance owed, release that deficiency balance, and cease any collection efforts. So they were willing and ready to wire those funds immediately if we were able to accept this. So of course, we don't want to go through the suit on note process. There's two ways to pursue your mortgage investment: either through the mortgage as a foreclosure, you have a secured interest, you have leverage on the property, or through the note in a legal case, which is just suing on the note because the borrower owes that money, where there isn't any leverage if the borrower doesn't have any assets. So in this case, though, we didn't want to go through that suit on note process, so we were done deal. Even though the balance is $24,000, we'll accept a $3,000 or $4,000 payment to not go through the legal process and to help the borrower. At the end of the day, we're helping them resolve over $20,000 of additional debt for a great discounted payoff, and we were ready for that. So in this case, we bought the loan for $2,100, 10.5% of the balance. That was way overpaying as an unsecured loan. And probably a lapse in the due diligence, or it was secured and then became unsecured as soon as we bought it. I think that was the case on this one. But we cut our losses here and actually made a little bit of money. So $640 of expenses. Took a long time, 21 months, because we weren't actively pursuing this. This was kind of just sitting on the shelf as an unsecured loan that we weren't intending on, and you'll see that in the takeaways, weren't intending on suing on the note. We weren't intending on trying to pursue the deficiency judgment, but the borrower was proactive, and that was a really great situation for everybody here. So the takeaway: although the mortgage is no longer relevant after a loan is unsecured, because as you know, there's two documents, the mortgage and the note. The mortgage unsecured doesn't matter anymore, but there is a promissory note connected to that mortgage, and that promissory note still represents a debt against the borrower. This is an obligation that they signed and they still owe. So you do have limited leverage as a note investor with an unsecured loan, but you can take what you can get. And in this case, an unsecured payoff of, more than we paid is much more than we could expect if we weren't willing to go through that legal process. So collection is often worth way more trouble than it's worth, especially if the borrower doesn't have any other assets. Now, if they have other assets available, there is a process where you can garnish your amount against their wages or connect the judgment to their other assets. If you get very, very aggressive, that's possible, certainly. But that's not typically the business that we want to be in. We want to help our borrowers out. So in this case, we were okay with that $3,500 payoff. But here's a little tip for you. Here's a little trick. Offer a small bump when negotiating to give the borrower the perception of a good deal. Otherwise, they may think they have offered a little too much. Now, if this borrower said $3,500 and I was really eager to say, done deal, we'll take it, they may have been overthinking it and like, well, what if I offered $2,000? What if I offered $1,000? It's like, where's that number? So if you come back to them and you say, oh, well, $3,500 appreciate the offer, but we need 3746. Make it very specific like that. So then they see that there was a lot of thought that went into calculating that counter offer. That'll give them a much better sense of accomplishment. They're going to be able to pursue that discounted payoff without buyer's remorse. Honestly, I think that it makes a big difference when you're not putting them in a position to overthink it. So just a little tip there when you're working on discounted settlements. All right, so this deal was only a 45% internal rate of return. It took 21 months, so that really ate into the return for sure because we weren't pursuing this loan actively. But we made money on the deal, which is amazing when you look at an asset like this that was essentially lost because it was unsecured and we didn't have that leverage anymore. So that's it for the case studies this week. Thank you so much for joining us. We'll talk about our upcoming schedule and our giveaway, and then we're going to feed the coin, wrap it up. So to start, yes, 15-minute consultations are my free giveaway. I would really appreciate it if you've subscribed to the channel and liked this video. Leave a comment with any questions or any comments along the way. It really means a lot. It helps our channel hugely. And if you want to book that 15-minute consultation, just go over to robbymax.youcanbook.me. Get on my schedule. Love to talk shop and see how I can help you in your business. So the upcoming schedule, we've got our mastermind call coming up in the beginning of October 5th. First Wednesdays of the month are our mastermind members only calls, which you can unlock all of that data, all of those recordings as a mastermind member. We've got upcoming our 10th mastermind members only call. So you have 9 recordings to listen to as a new member. And then we've got final Wednesday of the month for the Be the Bank show that you're watching right now. So tune back in on October 27th at 1 p.m. Eastern for our next episode of Be the Bank. And leave a comment if you have any suggestions on what you want to learn about. Since we went through the entire due diligence workflow, we've got a kind of an open book here from where we take the show next. So of course, I do want to pitch that mastermind members only. Again, our website, the mastermind and consulting. Definitely consider if you are serious about your note investment career. And if you want to join it, go to FIXnotes.com/MNM for Mortgage Note Mastermind. And then finally, if you are a mastermind member, podio.com/FIXnotes/mastermind is how you log into the mastermind group. All right, so that is it for today's episode. Thank you so much for sticking with me to learn about sustainability and some of my thoughts on sustainability in business and note investing in particular. And tune in next week or next month for industry overview, tech tips, vendor reviews, assets for sale, case studies, giveaways, and so much more at Be the Bank, last Wednesday of the month. All right, so let's just say hi to the birds, nobody, and the fish. They're ready to eat. So I'm gonna walk outside and I'm gonna give them a little bit of food and then we're gonna call it a day. Thanks for joining us, everybody. Have a great one.